TradeTheMBI.com. This is John. This report is for February the 8th. Well, we had a little bit of a downdraft and a bit of a nice upswing, and it was really pretty looking on the 5K charts. I mean, it was super clean with that. Puts us right in that middle range. Again, we saw no activity from MBI White suggesting that the supports would hold, and they did. The 76% was just fine. That little bit of a downdraft got closer to filling in that positive extreme that happened here at the beginning of the turnaround. And we're still floating right on the precipice with the MBI magenta and that of weakness in that. But you still have cyan under red. So that makes it easy. That it gives confidence when it comes to buying when you see dips coming through, at least from intraday signals, because then you're at least have a stronger presence that, support levels that have been major are definitely going to have support at that particular range, as opposed to just hoping that a line does it. The readings indicated that there's still plenty of buy activity, which is juxtaposed to most people's opinions. I mean, you look at the surveys, and then most Americans think things are going down and down fast, but that the market still keeps rising, and that's just that counter trade, and it can go that direction for a significant amount of time before correcting to it. We definitely see the potential for the headwinds. Some people think that the Fed is making a beautiful straddle between rates and that they're still far under par as far as the rate of inflation. But of course, all you have to do is just keep adjusting the way you calculate inflation, and it magically looks like things are better than they are. Most people are experiencing real inflation, really aren't buying the numbers. And this gets back into the same thing with the jobs reports. We do it so differently now than it used to be that if you use the older formulas, the numbers are dramatically different and not correlated. But we haven't been correlated with the real world since 2008, when the Fed decided to take over the markets, and um, they've normalized some, but still no. Completely arbitrary. But the more, and this is something I've talked about before, the more the dollar is devalued from that presence, the market will rise to cover that loss in value. This is the same thing that's going to happen in oil. And you have to keep that in mind when you're having hyper bearish views, because from the market standpoint, as the value of the currency decreases, they're going to uplift the overall index as well as with oil, because they're not going to suffer the loss. And same in the oil markets now that all currencies are being devalued to commodities and or even potentially to cryptos later. Um, that's just the reality, and that just reflects the significant amount of money that has been printed, is continuing to be printed, and it's not stopped. You saw for the Nasdaq there, exactly the same situation. Treasuries, again, that yield has to go up arbitrary low, because again, market, well, at least certain players think that, of course, the Fed has to cut when it reaches its target, but there really won't be any justification to it. There was never a justification other than the absolute financial collapse to have rates at zero. They've always traditionally been around this level. It's just people don't remember because they haven't seen it in so long. So, and the potential for the Fed to have to significantly tighten if things improve a little bit, inflation will rear its head. You're going to get a period where there's a little bit of a stagnation in the rate of increase. Prices aren't going back anywhere. It just doesn't happen. So it's just one of those things where you better get used to it. And, um, we saw the misplay in treasuries from before, and they'll do it again. So all we have to do is just follow the readings. But understanding the mechanism behind it, I think, is important, because it's really not explained that clearly. Um, it's not just going to be like for oil here enough to have the influx of production, and that they're also going to take into account that currency relationship and um, what they want to get for that same barrel. They're not going to accept a loss in the amount of what they can get for the same barrel of oil. And so you may end up with a permanent new minimum level, where we thought before you could get into the 30s or 40s. Now, upper 50s and 60s may be the bottom limit. So it's just something to bear in mind and accept. There's nothing you can do about it. You just have to understand why it's taking place and why it may seem dislocated to what you think is happening in the real world, because it's not all that dissociated or dislodged. So here we have gold working its way back up, and it's going to continue to do so just slowly. It's again, that paper trade is easily manipulated versus the real demand level. And eventually that plays out, and that's why we've seen the slow creep. But you're going to get those sudden dips, and that's normal with commodities like that. They're going to fade and accelerate based on what they think is happening. Of course, if war footing increases, the gold is definitely going to skyrocket again. You're all holding on to this mid 1.7 handle. I think that they'll probably still keep it between, like I've always said, that 111 um, and 114 was the previous range. They're probably looking at somewhere similar to that, maybe just slightly lower, as low as the 104 range. They just don't want it to go back testing below that 104, because remember, we talked about this before. Once it broke below, it was real crisis mode, and people were panicking. When we dropped down to 0.96 there at the lows, uh, US Fed literally stepped in and provided unlimited liquidity. And without that intervention, the euro was in serious trouble. Not that it shouldn't be, because the eurozone has just unbelievable amounts of problems and nowhere to dump off the debt that they have from all the different member states. Even when they create these facilities, all they're doing is mimicking the Fed buying up its own debt. It's just a shell game. From a Bitcoin standpoint, holding on to its support right there at around that 22, even though we're in that decrease. But again, cyan under red just lets you know that this is just a reset of the MBI readings. Slight increase in the MBI white that could trigger a little bit more, particularly with the steel, though now above negative 13.5. That's going to provide some support to hold on to price there. So shouldn't be anything too critical from that standpoint. And ETH much stronger from that aspect, and big difference between the MBI readings, not even close to eclipsing the white, and that cyan under red still uh, beautiful. From a 50K standpoint, so this is what we had during the day. We ended up with some early softness, nice push up, and then complete collapse, only to turn around and finish above that peak level. We're right back at the top of that range again. No shock there. From an intraday standpoint, this is what it looked like. We had the little softness, very clean. Then the buy came through, a little bit of softness, turned around, fought through it, and then boom, and cleared all of the previous algo support levels. And then it went into full dive after, because again, we can just go through and look. These are the positive extremes from the extreme histogram where it's red. So you knew you were coming back down just below that, well, to the 41.17, so just below the 41.23 range, and it carried all the way down to that lower one at the 41.03, and then fought so hard right in between there. Interesting, they had the first one with the pop above 23. You knew you were going to revisit the lows again on that one, and then did it again, but this time the magenta stayed above the 33, and then kicked in real strong with the dip of orange below and cyan under red, and that was off to the races. There just wasn't anything that was required to do other than just let it run. And when it got a little peak, revisit to the 76. Orange did its beautiful little dip again, and we stayed pretty consistently with that shakeout. We didn't get that shakeout that strong, and you had gold rising. These were pretty strong trend moves. So plenty of money out there buying it. No question about that. So hopefully that explains a little bit more on the broader side of the macro construct, so that you get it out of the idea of trying to presuppose the market is doomed or destined for major move, those kinds of things. You just have to follow uh, that broader logic and understand why some of the things happen, even though it seems contrary to the reality that exists. As always, though, trade well. We'll talk again later. See you on the Skype chat.